Right, without any further ado, I would like to welcome the Governor of the Reserve Bank, Adrian, back to the New Zealand Economic Forum. It was great to have you here in person last year, Adrian, at your old university. No doubt brought back some memories, and hopefully next year back in person again. But in the meantime, looking forward to your talk today. I'm sure it will be keenly watched, given other statements earlier in the week. We'll hand over to you. For those watching online, please do get questions through on Slido. I'll receive those here in the studio, and after Adrian's speech, we'll have the chance to put some questions to him. Kia ora, Adrian, over to you.
Kia ora ana tātou katoa, tēnā koutou katoa, and thank you, Matt, thank you, Waikato University, for this opportunity, and welcome everyone, and I look forward to your questions. So today we're putting a speech out on the record, so the good news is you can put your notes down. You'll be able to read what I've had to say in the comfort of your own homes. And yes, I do look forward to being there in person, and I strongly believe that will be the case for this time next year. So central banks around the world are currently confronted with a significant challenge, and it's a challenge we haven't seen for some time, but it is a challenge we're familiar with, and that is rising inflation pressures. The unfamiliar part really is the environment within which we are tackling this inflation challenge. These environments are always unique, and the world is always uncertain. So this morning I really just want to touch on the context that we made our monetary policy decisions in, particularly over this week, and also some of the challenges, both the ones we have faced and we face ahead, and in particular the unique aspects of these challenges for monetary policy. So without doubt, the COVID-19 pandemic provided really a unique setting for many central banks. We had to meet our low and stable consumer price inflation goals, really in the context of a unique and emerging health economic shock throughout the world. In early 2020, there were some really challenging factors facing policymakers, economic policymakers globally. The economic outlook, and hence any optimal policy response, became very dependent on the scale and the severity of the COVID-19 virus. This scale and severity, in the meanwhile, became dependent on a host of factors, how individuals, households, governments and central banks would react to the pandemic environment, the pace at which a vaccine would be developed and how effective that vaccine would be, and how quick it could actually be rolled out internationally. And of course, how the virus would evolve over time. So we're still amongst this at the moment, but they were very unique and uncertain challenges for us. Epidemiologists throughout the world struggled to model and predict the path of the virus, but these predictions played a considerable role in how governments and central banks developed any appropriate economic policy response. From the outset of the shock, we made it very clear here at the Reserve Bank and through our Monetary Policy Committee that any search for economic certainty was futile, and instead we needed to provide as much monetary policy certainty as possible within that uncertain economic environment. This is why we adopted a least regrets framework for deciding on our actions, and we continue to do so today. And by this, we mean ensuring that we avoid the worst policy mistakes while maximising our ability to continue to meet our objectives over the medium term. In early 2020, the risks to the global economy were heavily skewed to the downside. It was an incredibly biased outlook to the downside for inflation and for economic growth and employment. Governments had deliberately restricted economic and social activity so as to control as best as possible the spread of the COVID-19 virus. People also acted to protect their own personal health and well-being first and foremost. New Zealand faced a very material threat of experiencing a prolonged period of below target consumer price inflation and employment levels well below any measure of maximum sustainable levels. The situation that we most wanted to avoid was one where inflation and economic activity and employment became persistently depressed. We were especially concerned about the scarring impact on New Zealand's economic capability as business investment came to a halt, and to avoid high unemployment becoming persistent through time. So obviously our path of least regrets was to move very quickly to ease monetary conditions and to take other steps to bolster what I would call cash flow and confidence throughout the economy through this initial wave of uncertainty. A unique challenge was, of course, that we entered this period, like many central banks around the world, with nominal interest rates very near their effective lower bound. By that I mean where the official cash rate, any further reductions in the official cash rate become ineffective in bringing forward spending activity. I mentioned this was the case globally, and it followed after a very long period of low and stable inflation and declining global real interest rates. So it meant that the committee, like many other peer central banks, needed to supplement our official cash rate policy tool with additional forms of monetary policy easing. Our aim was to further lower long-term interest rates below what we could achieve with the official cash rate. Fortunately for us, we had been preparing for these types of situations prior to the COVID-19 outbreak, and so we were able to operate and work pretty quickly in the face of this shock. We responded to the COVID-19 shock initially by lowering the official cash rate by 75 basis points. So we took it down to as what we would consider its then effective lower bound. And we implemented additional monetary policy tools. And this included the large-scale asset purchase program and the funding for lending program. Our monetary stimulus over time was thankfully accompanied by significant government spending and investment, fiscal support, including transfer payments. And this was incredibly important given some of the specific supply side nature of this economic shock. The government's response in the end turned out to be one of the largest across the OECD, across advanced economies. And it was very welcomed, again, I should say, from the Monetary Policy Committee. The combined health and economic policy response of New Zealand has to date been ranked as one of the most effective across a wide range of countries. I will point you towards some recent work that David Skilling, a New Zealand economist, has produced a simple hybrid index of economic health measures and economic outcome measures, and it puts New Zealand, at the top, towards the top end of the nation's global response, with the massive caveat that the pandemic is not over yet, of course. The Reserve Bank's monetary policy response, looking ahead, that was the early stages, and then more recently, and looking ahead, our policy response is always going to be based on achieving our mandate. We set our policy responses on the information we have to date in hand, our assessment of how we think the economy best works, and of course, retaining optionality around being able to evolve policy through time and be resilient to any unanticipated future economic shocks. We are, of course, aware that monetary policy can only provide a temporary buffer to any economic shock, and really it's by bringing forward household spending and investment or delaying household spending and investment. So, we understand that our impact on the real economic activity is primarily temporary. As more information has become available and we've had time to observe how our economy and the global economic outlook has evolved, our policy response has evolved. In aggregate, we've been very pleased with how remarkably resilient the economy has remained in face of such high uncertainty and economic and social restrictions. We managed to avoid the worst scenarios of embedded deflation and unemployment, but we now face a more traditional challenge of constraining consumer price inflation, but still within this unique context of this COVID-19 pandemic. We're now sure that employment is above its maximum sustainable level, and we are very sure that inflation is too high. And this is occurring, of course, this challenge for us is occurring at a time when New Zealand is now experiencing its first widespread outbreak of the Omicron virus. To a significant extent, the recent increases in the consumer price inflation have been driven by global disruptions that have caused very sharp upward price pressures in the economy, in particular for critical commodities, but a broad range of imported goods and services. I've just referred to the events that are ongoing at the moment in Europe. That's just another example of how commodity prices can spike. We've seen now oil prices well north of US $100 per barrel. So these prices are things that monetary policy can do nothing about, particularly New Zealand's monetary policy. In the decade prior to the pandemic, all of this imported consumer price inflation into New Zealand was actually putting a downward pressure on overall CPI inflation. We had these deflationary tradables price pressures, and they make up a very large proportion, around 40% of New Zealand's total consumer price index basket, and they acted as an anchor to total headline inflation. Meanwhile, domestic-driven consumer price inflation, the non-tradables inflation, averaged more than 2% per annum over these years. So headline CPI inflation was being constrained by below-average tradables inflation and above midpoint non-tradables inflation. Downward pressure on prices from global competition and technology progress has, at least for now, abated. This has resulted from the pandemic-induced shocks to changes in demand patterns, for example, from services to goods, the ongoing supply disruptions that are everywhere, and the reduced mobility of goods, services, and labour. What it means is that we can no longer rely on declining price pressures from these internationally traded goods and services. And central banks globally are grappling with exactly this challenge. New Zealand's monetary policy, of course, has no direct influence on these imported global prices, other than perhaps indirectly through our exchange rate. And even then, that relationship is far from certain. The global nature of the economic shock really has meant that exchange rates have been incredibly stable over recent times. The whole world experienced this COVID-19 shock at the same time, and it means there has been very little relative work for exchange rates to do adjusting to the shocks. And in fact, over recent months, what we've seen is that global interest rate differentials have narrowed, as other central banks have moved towards more of the tightening horizon that we have, and we've seen the New Zealand trade-weighted index exchange rate decline, and it's currently down around 7, if not slightly higher percent, down around 7 to 8% from its pre-pandemic level. The most notable driver of inflation pressures has been, in terms of New Zealand, has been oil prices. But I will say that that tradable inflation is far more widespread than just oil prices. The global economy continues to struggle to supply sufficient goods and services to meet the strong ongoing demand. There's both a catch-up from demand running ahead of the supply, and there's also continued ongoing supply into the future. So the degree of inflationary pressures experienced across economies has to some extent very much depended on the different starting points for economies as they headed into the economic pandemic. We do have to remember that most of our advanced economy trading partners had experienced for a very long time very low and subdued inflation and persistently high unemployment. In fact, it was only until recently the central banks of Japan, the United States, the Euro area, Australia, and less so here in New Zealand, were all increasingly concerned about undershooting their inflation targets rather than overshooting. And obviously, this has since been tipped on its head by this pandemic. Central banks are now signalling and undertaking policy tightening. These policy responses do vary across countries based on the starting points for inflation, for output gaps, for employment, but they're all heading in the same direction around reducing stimulus and starting to tighten monetary policy. Enough about what's gone on internationally, around which we have limited influence, if any. Back here at home, domestic inflation pressures have also been rising. And this is an important reason why the committee has responded recently with tightening policy, and why we continue to have to expect to do so until we know that our inflation expectations are well anchored and we will have consumer price inflation back within our target range. In one sense, this is business as usual. New Zealand has a long history of bringing inflation down, as does the rest of the world. Where we have a shorter history is working out how to bring domestic inflation back up. So we're using our tried and trusted monetary policy approach, and that's to ensure that inflation comes back into its target. And of course, we have to do this without causing undue volatility in interest rates, the exchange rate, and output and employment itself. Again, this is our mandate. It's our business as usual. Our path of least regrets has now become one where we must ensure that consumer price inflation and inflation expectations do not rise persistently above our target level. And I think anything less risks long-term economic costs and reduced well-being for all New Zealanders. I suppose to highlight our resolve to meet our remit, it's useful to compare our actions globally. Amongst many of our central bank peers, we were one of the first to begin removing monetary stimulus and start this tightening cycle. We ceased our quantitative easing activities in mid last year, July 2021, and this was by ending the purchases of government bonds. And over the remainder of 2021 and until recently, we have now lifted the official cash rate 3 times, so by 75 basis points. Importantly, we've also signalled there's more to come, and we have talked a lot about where we believe the neutral nominal interest rate is and how far we may need to go above neutral to achieve our inflation targets. So really the idea is we're taking our foot off the accelerator as quickly as possible to avoid having to use the brake unnecessarily in the future to maintain our inflation mandate. So that's all strictly central banking tasks, nothing particularly unique or unusual globally, more unique and unusual historically. Some of the challenges that we've had to face through all of this have been, have provided great lessons, and we'll talk about how we're going to try and capture these lessons and work with everyone on this call in the near future. One real interesting challenge was the immense government fiscal support that occurred internationally. It was very timely, it was well received and necessary. The level of that fiscal support in response to the pandemic was much larger than we've seen in any recent shocks, and that was both in timeliness and scale. In New Zealand, fiscal support for bolstering aggregate demand was very welcomed by the Monetary Policy Committee, given the size and the pace of the shock we were dealing with, given the ongoing low nominal interest rate environments, and given some of the very specific supply side effects of the health response that were undertaken globally and, of course, here in New Zealand. We do acknowledge now, though, that the bulk of the fiscal impulse is behind us. The government's response to the COVID-19 pandemic was very strong over 2020, 2021, and looking ahead, it's becoming more business as usual for fiscal policy. The Treasury's current outlook suggests that fiscal policy is expected to be less stimulatory for aggregate demand in terms of impulse, and hence add less upward pressure on spending or potential inflation in the economy. The committee's ongoing challenge, of course, is to ensure that inflation remains low and stable through this period, and that the fiscal policy can go about its longer-term activities. And I understand you all heard from Carolee McLeish yesterday, which was a very clear articulation of their challenges. While fiscal policy has been an incredibly important tool for this aggregate demand management, I would say that monetary policy will need to be stepping back up more into the front line over the period ahead, as it remains the most effective tool for stabilising economic activity through business cycles. And this is largely due to the ease and frequency with which we can adjust policy, our operational independence, which is critical to enabling us to go about our business, and of course these potential significant economic costs of dynamically adjusting government spending, taxes and transfers to cyclical behaviours. Of course, we will need to continue to observe ongoing fiscal decisions, and our monetary policy actions will ensure that any implications of fiscal spending or fiscal policy, taxes, spending, welfare transfers, and of course policies around border opening, labour mobility and other things that impact on the supply side of the economy. These are all critical inputs into setting our monetary policy decisions. I do want to emphasise, of course, that there is no simple rule of thumb between fiscal spending and an inflation outcome, or government decisions and an inflation outcome. It's going to always depend on the impacts of supply to the economy, what's happening to the long-term productive capacity, any implications for demand, and of course any offsetting implications for what it may mean for private sector investment or spending decisions. So there's no simple rule of thumb. It's all about the nature of the spending, the nature of the tax changes, and the nature of the regulatory environment that ultimately depend on an optimal monetary policy response. Another real challenge for us, and one that has been very high profile and will continue to be, really is the role that monetary policy has played with regard to asset prices and asset price volatility. In New Zealand, this has been most evident and most talked about through residential house prices. Like high consumer price inflation, the rapid rise in asset price inflation has been a global phenomenon. But the increase in New Zealand house prices has been exceptional and well above global averages. And it's taken New Zealand house prices, what I would say is well above a sustainable level. By sustainable, what we can explain just through traditional supply and demand type modelling. Our research shows that it is the persistent decline in global nominal interest rates that most affect asset prices, whereas changes in New Zealand's official cash rate relative to the global rate has a much smaller effect. And we've been observing this global secular decline in interest rates for at least a couple of decades, driven by that low global stable inflation, a long period of very low inflation, and structural factors that I know this audience knows well. Demographic issues, productivity issues, all things that affect the level of expected real economic growth in the long term. A key reason why lower global interest rates have had such a significant impact on house prices in New Zealand really has been the lack of supply of housing itself. Land use restrictions and other constraints on building have restrained the supply of land and hence housing. I do note, though, that this trend has recently turned. Building consents are at a record level, and this is at a time when the population growth through 2021 was just less than half of 1%, its lowest level since 1988, and mortgage interest rates are now rising, and there is tighter access to credit. We're now confronted with thinking about how asset prices will react to this rising interest rate environment, and how homeowners might react to declining household balance sheet worth. I will reiterate that house prices have remained at a very high level, and I will note that household balance sheets and corporate balance sheets are in a very strong position. But it will feel different if house prices start to decline, and we're seeing aggregate household balance sheets being impacted already through their KiwiSaver accounts and other financial investments as the global economy, as asset prices respond internationally to rising interest rates. We also recognise that monetary policy has distributional impacts, including through the housing markets. Our research has shown that monetary policy easing and tightenings can affect the distribution of wealth and income through multiple channels. But our mandate is very humble and appropriate. It recognises the limitations that monetary policy has on influencing these distributional effects. The best impact monetary policy can have is reflected in our mandate, and that is through maintaining low and stable inflation and doing so in a manner that contributes to maximum sustainable employment. Of course, Te Pūtea Mātua, the Reserve Bank of New Zealand, is what we call a full-service central bank, and we have responsibilities for both monetary and financial stability purposes. Our purpose for responding to any unsustainable asset price movements is really to ensure that the broad financial stability is maintained. We would love to ensure that both borrowers and lenders are able to manage their financial risks through good times and bad, and that any specific issues to the otherwise do not lead to broad financial instability. So to manage some of the cyclical drivers of financial instability, we have been deploying over the recent decades an increasing suite of macro-prudential tools. Since the onset of this pandemic, we have been active in using these tools, particularly the key tool around our loan-to-value ratio restrictions. At the onset of the pandemic crisis, we removed our LVR restrictions, loan-to-value ratio restrictions, and that was so that we could be confident that monetary policy would be its most effective, that that banks were able to have full use of their balance sheet to bring forward spending and investment. By early 2021, we were in a much more certain position, and we were able to see how the pandemic was evolving, and we were confident enough to put restrictions back on put our LVRs back in place, and in fact tighten them in a means of heading off any undue financial risk and high leverage, particularly for people entering the housing market in recent times. So that will always remain an important and active part of not just monetary policy, but macro-prudential tools to assist cyclical challenges the economy faces. Another real challenge for us was both, and the broader bank, of course, and the fiscal authorities, was in the design, the implementation, the calibration, and the explanation of our additional monetary policy tools. In particular, on the explanation front, a significant challenge was this persistent singling out of the new tools as the cause of house price inflation. But as we all know, causation and correlation are different concepts. The additional monetary policy tools that we utilised were simply there to assist lowering nominal interest rates across the yield curve. It was up to the financial institutions and individuals to decide how to utilise these lower interest rate environments. It was not simply a cash flow transfer from us into households to buy houses. It was about lowering interest rates. It was business as usual, albeit through additional tools. Our large-scale asset purchase program affects long-term interest rates really through this exchange of settlement accounts at the bank with retail banks for their bonds, and that puts downward pressure on bond yields and hence downward pressure on the yield curve and interest rates in the economy. The level of government bonds on offer is determined solely by the government, the fiscal authorities, not the Reserve Bank. Likewise, the amount of bonds the committee chose to buy depends solely on the committee's needs, not the fiscal needs of government. So monetary and fiscal policy remain separate and the operational independence of the bank remains clear. Looking ahead, we are continually reviewing our work to improve the implementation and formulation of monetary policy. Our new legislation, which comes into work in July 1 of this year, actually requires us, which I think is a wonderful thing and consistent with what we see across other best practice central banks globally, it requires us every 5 years to do a thorough review of these monetary policy tools. And the idea is to ensure that we remain accountable, transparent, effective and capable to undertake the monetary policy remits. Our review process, it's now underway. We've kicked it off internally and we are about to go externally, and we are going to be encouraging, insisting that you all take part in assisting us work through this review. We're thinking about it in two legs. The first one is a backward-looking review and assessment of our policy performance over the last 5 years. And the other part is about formulating advice on the monetary policy remit for the Minister of Finance about what, if any, changes are needed going forward from these lessons. We are legally obliged through the legislation to have this advice in front of the Minister of Finance no later than towards the end of 2023. But this is going to be a project that we're undertaking. It will involve public consultation, and the first round of public consultation is in the middle of this calendar year. We're going to be looking at a lot of the structural changes that may have impacted on the remit and the operation of monetary policy and the lessons of activities of recent years. So I encourage you to take part in this. It's really exciting to be involved, and it gives us a great opportunity for everyone to be able to contribute their thoughts. I'm going to finish up then just to say, look, what have I done? I've outlined the unique global context to monetary policy, some of the unique tools and contexts that we've operated in. I've acknowledged the role of asset prices and distributional impacts that monetary policy can have on these issues. And of course, I've put the pānui out and the flag up for the review of our monetary policy remit. Mei taki mai ata. I look forward to questions.
Kia ora, Alistair. Thank you. And the first reflection is just the degree to which you and your team have been in the hot seat over the last couple of years. Monetary policy's probably never had quite so many clicks on the mainstream media than in the last couple of years. Look, a lot of questions coming through over Slido, and please keep them coming through. I'm going to start with a bit of a nuts and bolts one. You've picked inflation coming back to more normal levels, we might call it, within target ranges, I believe, by mid-2023, which is sooner than some might have picked. And yet you're also looking at an official cash rate up above almost 3.5% out to 2025. So can you guide us through the committee's thinking on this and where we see, I guess, how long do we see inflation there? What gives you confidence that it's going to come back within bound, and yet you're looking at that higher OCR out, 3-4 years?
Wonderful. The first thing that gives me confidence that inflation will come back. I'm sorry, mate, you might need to go on mute. So the first thing that gives us confidence around the inflation is our policy remit and our operational independence. So, we can still have significant and effective influence over consumer price inflation within our monetary domain. and that's our task. Now, the second bit around what we have to do to achieve that, I think it's really important to remember where we're coming from is as important as to where we're going with the official cash rate. So we're coming from an extremely historically low nominal interest rate. And a lot of the work we're doing at the moment is simply getting us back to a neutral interest rate, and then we're saying we may need to be north of that for some time to be effective, i.e. slowly stepping on the brake. Neutral nominal interest rates, I can't believe I'm saying this, but we say around 2% nominal. That still feels incredibly low historically. And so, for a lot of people out there in the economy, this is, they're going, wow, interest rates are rising, but they're going from something very low to something at most quite average, and if not just marginally above average. So it's not quite as dramatic as it may feel, and that has been part of the warnings and discussions we've been trying to put out to people, that normal interest rates are well above where they are making their first borrowing decisions. The good news is that a lot of that rate rise that we are talking about with regard to the official cash rate is already priced in to those forward-looking curves, and in a large part being reflected out there in mortgage rate land. And we know that over half of all mortgages money that's out there at the moment is going to be reset over the course of this year. So there's a lot built in and a lot that will already happen, but we must follow through with what we've said as well in order to bank that tightening that is priced in at the moment. With regard to the actual inflation, a significant part of shifting from where we expect to be peaking between 6.5%-7% first quarter of this year. I'm deliberately being quite loose on the first quarter CPI inflation because the swing variable, of course, is oil prices, and so this is the noise that happens in near-term inflation. Now, a lot of those are one-off price level shifts that even if they don't go back down, the mere fact they don't keep going up, you're going to see measured CPI inflation come off over the course of 2022 and into 23. We don't see headline CPI inflation getting below the 3%, just getting into our target range until next year, and being at the midpoint of our target range until the year after. So you can see we are still trying to ensure expectations remain anchored, but not be too dramatic to interest rates output the exchange rate. We're trying to focus on that horizon that we are most impactful on and do it in a credible, transparent manner.
Thank you. And thank you for the clarification. I'm going to go a little bit back into the days 2020, and I'm sure they were they'll stick in your memory. It must have been a sense of drama almost certainly across the world as everybody was figuring out how to respond to the situation and then maybe look forward. You've talked about the legislation requiring review. I think that's excellent. It's part of the long run of, you'd say, New Zealand's legislative tools around central banking, which have put us in a very strong position. When you go back into that period, when was it that the bank made the switch? And I guess all of the world, if you consider the economic consensus at the time around demand shock, and then of course we've said now actually it was more on the supply side. When did the bank start seeing that and start switching that view? Because of course many of us have gone through, and we all know a lot more now, so it's a lot easier 2020 hindsight. When did the bank start seeing this as more of a supply shock versus demand?
Yeah, so I would say right from the outset, we were very convinced it was going to be both a demand and a supply shock. But in our least regrets framework, and given that demand is immediate, supply takes time, we could see very strongly that the risks, even though it's both demand and supply, this will dominate, demand will dominate first, and we needed to dramatically reduce monetary conditions. We also had to dramatically reduce monetary conditions because being the only one standing there with higher than otherwise interest rates, etc., we would have had the exchange rate going through the roof. So part of it, so the immediate shock to demand and supply, demand wins the day, do that, and then let's see where the dust settles around what the supply capacity or constraints actually are in the future. When did we have confidence around the demand? had stabilised, and when did the supply issues really start to become evident? That was more towards the end of, and I'm struggling to do it, more towards the end of 2020, and this is when we had said, don't expect a lot more. We are just maintaining monetary conditions at the slow level. We're not looking for additional things to do. And fiscal policy was the main show in town. We were actively trying to take monetary policy off the stage and say this is from here a fiscal policy show. And that was because of the more targeted nature that fiscal policy and general government policy could take on sectors of the economy, on supply side issues of the economy, that monetary policy just had no effort over. And as economic resilience proved, both on the global side in particular, and the holding up of commodity prices and our terms of trade holding up, and as we saw the wage support and businesses maintain, balance sheets maintain their strength through all of the unprecedented fiscal policy response, that gave us the confidence by mid-2021 that we could now start to exit this extraordinary monetary policy loosening period and start to renormalise in a manner. Now, remember, all of this is still being done in the environment of the ongoing rolling pandemic.
It's heady times without even factoring in the events in Europe overnight. So it might be a last question, given time constraints. We could go for hours. It's a theme again of what have we learned, and also looking forward. You've touched on distributional impacts. I look at the banner behind you, wellbeing and prosperity for all New Zealanders, and I know that you have made that a central point of the bank's focus. Obviously, some are sitting out there saying this is the stimulus that was needed in the early days. This has had quite devastating impacts on those that might not get into the housing market. You have made very clear there are only so many levers the bank has. But thinking now, again, hindsight 2020, it's much easier. But with hindsight, and as you go into this review period, if we were to have another similar crisis, what have we learned from the early days of what we as a nation went through then? Or, as one of the questions came through, did we over-egg it? Did we overstimulate the economy in retrospect? And what might we do differently now? Which I say isn't necessarily a critique on where we were, because now we have more information. But what have we learned out of last time that we could apply next time?
Yeah, I would say first and foremost, build houses. This is the continuous challenge of wanting our cake and eating it too. Not in my backyard, not on my watch. I'm against it. Challenges that are writ large globally, but especially strong in New Zealand. We had an unbelievable population growth and a very, very poor response around housing. I would be thinking hard around the lack of depth and breadth of our broader capital markets, which generally means that so much of our intermediation is done through reliance on housing as collateral, and also housing as an investment tool. So those are much longer structural things. I'm not obfuscating from where the central bank is, but I actually think it's really small incremental improvements you would make around monetary policy relative to significant changes you can make outside of this institution. When you say whether have we under or over-egged it, well, core inflation is at the top end of our band, maximum employment is slightly above its maximum sustainable employment. I would say that's not a bad outcome to date, given from where we've been, and we're now still firmly in control of keeping inflation down. What did the committee most struggle with throughout? Getting line of sight and timeliness around fiscal policy responses. You think internationally fiscal policy had been told go away as an aggregate demand manager, yet globally fiscal policy appropriately immediately stepped up and became the most significant. We had no real experience in New Zealand of direct wage subsidies or business guarantee schemes, etc., around how that would support and bolster housing. So that ongoing connectedness of monetary and fiscal policy whilst retaining the operational independence is critical. Number one, and number two, the terrorist, Te Pūtea Mātua and the Treasury worked incredibly closely together. And so, but we can always think much harder. I would love the academic effort, capability in this audience to be thinking around that monetary fiscal policy response and how our supply side of our economy can be more flexible to ongoing shocks and innovation.
I see a whole branch of academic articles coming out on this period over the years ahead. I mean, it's been some heady times. Look, we're at the end of our time. Adrian, thank you so much for your time and for your team's time. We'll, of course, now have a panel on monetary policy, so we'll get other views coming in, and then a session on fiscal policy as well. There are a lot of questions on the interrelationship between those two, part of a longer conversation another time, I think. But for today, thank you again and wish you well. Kia ora until next time.
Kia ora. Thank you. All the best.